Hello, business enthusiasts. Today, we're diving into the world of business entities, specifically exploring the intriguing LLC and corporation structures. Firstly, let's discuss the LLC. As a sole proprietor, you retain complete control over your business, but it comes with personal liability for debts and legal actions. Switching to an LLC provides limited liability protection and may help with taxation. On the other hand, a corporation offers more tax benefits than an LLC and also provides limited liability protection. However, it's more complex to form, and there's potential for double taxation on both corporate and personal levels. Remember, your business structure choice will depend on various factors like tax implications and legal protection needs. So, pick wisely. We do not claim to be accountants or lawyers. We are just providing information as described by the Internal Revenue Service (IRS). For all legal and accounting questions, please consult your attorney and/or accountant. When beginning a business, you must decide what form of business entity to establish. Your form of business determines which income tax return form you need to file. The most common forms of business are sole proprietorships, partnerships, corporations, and S corporation. A limited liability company (LLC) is a relatively new business structure allowed by state statute. The selection of a business structure should be based on both legal and tax considerations. Sole proprietorships. A sole proprietor is someone who owns an unincorporated business by himself or herself. However, if you are the sole member of a domestic LLC and you elect to treat the LLC as a corporation, you are not a sole proprietor. Partnerships. A partnership is the relationship existing between two or more people who join together to carry on a trade or business. Each individual contributes money, property, labor, or skill, with the expectation of sharing in both the profits and losses of the business. A partnership must file an annual information return to report the income, deductions, gains, losses, etc. from its operations, but it does not pay income tax. Instead, it passes through any profits or losses to its partners. Each partner includes his or her share of the partnership's income or loss on his or her tax return. Partners are not employees and should not be issued a Form W-2. The partnership must furnish copies of Schedule K-1 Form 1065 to the partners by the date that Form 1065 is required to be filed, including extensions. Corporations. In forming a corporation, prospective shareholders exchange money, property, or both for the corporation's capital stock. C corporation generally takes the same deductions as a sole proprietorship to figure its taxable income. A corporation can also take special deductions. For federal income tax purposes, a C corporation is recognized as a separate tax-paying entity. A corporation conducts business, realizes net income or loss, pays taxes, and distributes profits to shareholders. The profit of a corporation is taxed to the corporation when earned, and then is taxed to the shareholders when distributed as dividends. This creates a double tax. The corporation does not get a tax deduction when it distributes dividends to shareholders. Shareholders cannot deduct any loss incurred by the corporation. S corporations. As corporations are corporations that elect to pass corporate income, losses, deductions, and credits through to their shareholders. For federal tax purposes, shareholders of S corporations report the flow-through of income and losses on their personal tax returns and are assessed tax at their individual income tax rates. This allows S corporations to avoid double taxation on their corporate income. Certain S corporations are responsible for taxing certain built-in gains and passive income. To qualify for S corporation status, the corporation must meet the following requirements: be a domestic company, have only allowable shareholders, such as individuals, trusts, and estates, may not include partnerships or corporations, or non-resident alien shareholders, have no more than 100 shareholders, have only one type of stock, and not be an ineligible corporation, that is certain financial institutions, insurance companies, and domestic international sales corporations. Limited liability company (LLC). An LLC is a business structure allowed by state statute. LLCs are popular because, as with corporations, owners have limited personal liability for the debts and actions of the LLC. Other features of LLCs are more similar to those of a partnership, providing management flexibility and the benefit of pass-through taxation. Owners of an LLC are called members. Since most states do not restrict ownership, members may include individuals, corporations, other LLCs, and foreign entities. There is no maximum number of members. Most states also permit single-member LLCs, those having only one owner. A few types of businesses generally cannot be LLCs, such as banks and insurance companies. Check your state's requirements and the federal tax regulations for further information. There are special rules for foreign LLCs. Classification: the federal government does not recognize an LLC as a classification for federal tax purposes. An LLC business entity must file a corporation, partnership, or sole proprietorship tax return. An LLC that is not automatically classified as a corporation can file Form 8832 till they can elect their business entity classification. A business with at least 2 employees can choose to be classified as an association that is taxable as a corporation or a partnership. And a business entity with a single member can choose to be classified as either a taxable corporation or a non-taxable association as an entity separate from its owner, a disregarded entity. Form 8832 is also filed to change the LLC's classification. Thanks for joining today's discussion. If you found this video helpful, do give it a thumbs up and remember to follow and subscribe for more insightful content. Until next time, keep business smart.